Hello, and thank you for clicking in to the MacDesk Floor Report for Tuesday, September 20th. I'm Rebecca Darst from the MacDesk, speaking to you from the trading floor, where we've given back some of the earlier gains we saw in the pre-market, but we're still in positive territory. We're up about 92 points in the Dow, which is not too bad, trading on light volume. We were a little surprised to see equities rallying so sharply along with Europe ahead of the bell. Now, just to recap the news flow since last night's close, S&P downgraded its rating of Italy's sovereign debt from A+ to A with a negative outlook, suggesting that the agency is likelier to cut again in the future. Gold prices did not move very much in response to the downgrade, and while Tokyo opened lower last night, that was largely a catch-up move following a public holiday on Monday in Japan. This morning, credit default swaps on Italian, German, French, and Spanish government debt all moved higher, with Italian CDSs hitting an all-time high of 520 basis points over LIBOR overnight. German CDSs rose 4 bips, also hitting a record of 94 points. Apropos of recent chatter regarding the ability of certain European banks to fund their operations in dollars, the 3-month euro-dollar basis swap, which measures the cost of converting euro payments into dollars, rose overnight along with the cost of 1-year dollar funding. And the Euribor OIS spread, that's a metric we've talked about before, which measures the willingness of European banks to lend to each other, remains within 5 basis points of the September 12th recent crisis levels. Now, despite all of this, European equities rallied broadly, and they remained higher after the IMF cut its global growth forecast to 4% for 2011 and 2012. This was surprising to us, frankly. The upside was attributed superficially to speculation that Greece was close to putting together an austerity plan to placate its creditors. There was conjecture this morning that for the first time ever, layoffs of government workers might be on the table, with some reports putting the number at some 800,000 civil service jobs. There was also some speculation that Prime Minister Papandreou was planning to hold a Eurozone referendum. This was officially denied by the Greek government, but it seemed very odd that the market would rally on the prospect of a referendum that would not seem to indicate a slam dunk for the status quo in Greece. By way of responses to the downgrade, we would point to Credit Suisse, where analysts say that Italy's risk of default is a lot lower than the rest of the European peripherals, noting that its fiscal deficit is just over 4% of GDP, and its bank borrowing from the ECB is just 5% of GDP. You can compare that to about 45% of GDP for Greece. Fitch, meanwhile, has responded with comments of its own on Greece, saying that they expect the country to default on its debt but not leave the Eurozone. So all in all, we're left with a lot of uncertainty, a lot of macro headline risk out there that makes it particularly difficult to be a stock picker, but equities aren't selling off, and gold prices are barely higher today at just around $1,800 per ounce, having come off very sharply since the September 6th highs. A lot of the froth coming out of that market. Returning to U.S. shores, many investors are awaiting the Fed's rate announcement tomorrow afternoon. And the consensus here seems to be that a redux of a 1960s policy known as Operation Twist has already been priced into the market. This would be a policy of twisting the yield curve by rolling out of short-term debt and further out into the middle portion of the yield curve by buying 7- to 10-year notes that would help homeowners refinance their homes. VIX is down very slightly at just over 32. Remember, we haven't seen a settlement south of 30 for the volatility index since August 3rd, although the average year-to-date is barely above 20. For more on the market, check your inbox at 1 p.m. for the midday. For now, that's it for me, Rebecca Darst, for the MacDesk Floor Report.